Legal parameters of capital gains taxation on precious metals in the United States. 1. Scope and definitions. This section delineates the treatment of physical precious metals and related instruments under U.S. federal income tax, with emphasis on capital gains realization events, rate structures, and compliance obligations distinct from state-level sales or use taxes. Footnote. This section defines the analytical perimeter and separates federal capital gains rules from state transactional taxes. 2. Asset classification and tax characterization. Physical gold and silver bullion and most coins are generally classified as collectibles for federal income tax purposes. Upon disposition, gains are taxed as capital gains, with long-term gains potentially subject to a collectibles maximum rate rather than ordinary long-term capital gains rates. No general federal exemption exists for common U.S. bullion coin types solely by virtue of their origin or design. Footnote. This section establishes baseline federal characterization of precious metals as capital assets, typically under the collectibles regime. 3. Holding period and rate differentiation. Dispositions within 1 year are short-term and taxed at ordinary income rates. Dispositions after more than 1 year are long-term and, for collectibles, may face a higher statutory cap than standard long-term gains. Holding periods therefore function as a primary lever for rate outcomes but do not create exemption from tax. Footnote. This section explains how holding periods alter applicable federal rates without eliminating tax liability. 4. Tax-advantaged accounts. Acquisition of permitted precious metals through self-directed individual retirement arrangements enables tax deferral, traditional, or potential exclusion at qualified distribution, Roth, subject to statutory eligibility, custodial requirements, and prohibited transaction rules. Tax is generally deferred or excluded at the account level, not eliminated at the asset level. Footnote. This section clarifies that retirement account wrappers change timing and character of tax, conditional on compliance. 5. Securities alternatives to physical holdings. Exposure via exchange-traded funds, mutual funds, miners, or royalty companies is taxed under regimes applicable to securities or regulated investment companies. Character can differ from direct collectibles treatment depending on instrument structure, prospectus terms, and pass-through reporting. Footnote. This section notes that financial products referencing metals can yield tax outcomes distinct from owning bullion. 6. Loss harvesting and basis management. Taxpayers may offset realized capital gains in precious metals with realized capital losses from other capital assets, subject to netting rules, annual deduction limits against ordinary income, and wash sale constraints where applicable to securities. Meticulous basis records for each lot are essential. Footnote. This section emphasizes lawful gain-loss netting and the necessity of accurate basis documentation. 7. Gifts, inheritances, and charitable contributions. Gifts transfer carryover basis to the donee, subject to loss limitation rules, deferring recognition until donee disposition. Assets acquired from a decedent generally receive a basis adjustment to fair market value at death. Qualified charitable contributions of appreciated metals can yield deductions subject to valuation, substantiation, and property type limits. Footnote. This section identifies non-sale transfers that alter timing, basis, and potential deduction mechanisms. 8. Tax-efficient vehicles and constraints. Claims of intrinsic tax efficiency for particular metals vehicles require scrutiny of entity structure, distribution policy, and information reporting. Absent statutory relief, economic exposure to spot prices does not by itself confer favorable capital gains character. Footnote. This section warns that efficiency depends on legal form and tax rules, not on commodity exposure alone. 9. Product type, jurisdictional variance, and misconceptions. Differential treatment may arise between bullion, legal tender coins, and numismatic items for sales tax or import purposes, but federal capital gains taxation generally turns on asset class and holding period. Categorical assertions of federal capital gains exemption for specific domestic coins are inaccurate absent explicit statutory authority. Footnote: this section separates federal capital gains rules from disparate sales tax exemptions and dispels blanket exemption claims. 10. Documentation, reporting, and thresholds. Accurate retention of invoices, trade confirmations, and custodial statements is central to establishing basis and gain. Federal cash reporting thresholds, e.g., information returns for certain cash transactions, and broker information reporting may apply, but monetary thresholds for reporting do not create capital gains exemptions. Footnote: this section distinguishes informational reporting triggers from substantive tax liability rules. 11. Anti-evasion, structuring risks, and audit exposure. Artificial fragmentation of transactions to avoid reporting thresholds can constitute unlawful structuring. Patterns designed to evade information reporting increase audit risk and potential penalties independent of underlying capital gains calculations. Footnote: this section highlights legal exposure from attempts to circumvent reporting rather than comply with tax computation. 12. Professional advice and compliance governance. Given variability across states and product forms, consultation with qualified tax counsel or advisors is recommended to coordinate federal treatment, state tax exposure, substantiation standards, and estate planning objectives. Written advice should be retained alongside transaction records. Footnote: this section recommends expert guidance to align asset strategy with multi-jurisdictional tax compliance.